Tonight, we're going out front with the numbers that are impacting your wallet, and the story behind those numbers that's unfolding right now across the globe. Whether you drive to work, heat your home, or simply buy groceries, the price of oil touches nearly every part of your daily life. It's more than just a number on a screen. It's a force that shapes economies, influences policy, and affects the cost of living for millions. So let's start with the price of oil, a key indicator that's been making headlines and stirring up conversations in boardrooms and at kitchen tables alike. Today, November 11th, 2025, crude oil prices have dropped sharply, sending ripples through markets and raising questions about what's next for the global economy. Brent crude, the global benchmark that sets the tone for oil prices worldwide, slipped to just under $64 a barrel, a level not seen in months, and a sign of mounting pressure in the energy sector. Meanwhile, West Texas Intermediate, the U.S. benchmark, fell below $60. That's a psychological threshold for traders and analysts, and it's a number that can trigger even more volatility in the days ahead. These numbers aren't just for traders, they signal economic pressures we all feel. Lower oil prices can mean cheaper gas at the pump, but they also reflect deeper concerns about slowing growth, shrinking demand, and uncertainty about the future. This isn't a sudden shock, but the latest chapter in a year-long downward trend. For the past 12 months, oil has been on a steady slide, with each dip reflecting a mix of global events, from shifting energy policies to changing consumer habits and geopolitical tensions. Even a small shift in the market can cause big swings, and right now, the forces pushing prices down are winning. Supply is outpacing demand, inventories are building up, and traders are reacting to every new headline with lightning speed. The psychological barrier of WTI falling below $60 is significant. It signals growing pessimism about the global economy. When prices dip below key levels, it can trigger automated trading, spark sell-offs, and deepen the sense of uncertainty among investors and consumers alike. These prices reflect too much supply and not enough demand, and they're a direct result of decisions made in boardrooms, governments, and on the world stage. OPEC's production targets, shifting alliances, and the global push for renewable energy all play a role in shaping today's oil market. Understanding why oil is falling is the first step to understanding how your finances might be affected. As we watch these numbers, remember, behind every price drop is a story of supply, demand, and the choices we all make, at the pump, in the markets, and in our daily lives. At the heart of falling oil prices is a basic principle: supply and demand. This concept is the foundation of how markets work, not just for oil, but for nearly every product you can imagine. When supply and demand are in balance, prices tend to be stable. But when that balance is disrupted, prices can swing dramatically. When there's more oil than buyers, prices drop, just like a farmer lowering prices to sell leftover tomatoes at the end of the day. If the shelves are full and customers are few, sellers have to cut prices to move their goods. The same logic applies to oil, only on a much larger global scale. Right now, the world has a supply glut. Producers are pumping more oil than the world needs. Storage tanks are filling up, and pipelines are running at capacity. This oversupply puts constant downward pressure on prices, making it harder for producers to make a profit. High production and slowing economies mean less demand for fuel. Factories are running below capacity, and fewer goods are being shipped. People are driving less, and businesses are cutting back on energy use. When millions cut back on travel and businesses slow down, global fuel demand drops sharply. Airplanes sit idle, highways are nearly empty, and airports see fewer passengers. All of this means less oil is needed to keep the world moving. Tankers wait at ports with fewer buyers, forcing companies to lower prices to compete. With so much oil and not enough demand, sellers are desperate to find buyers, even if it means accepting lower profits or even losses. It's a buyer's market, and that's why WTI is below $60. Buyers have the upper hand, able to negotiate better deals as sellers compete for their business. The fear that oversupply will continue keeps investors pessimistic. They worry that prices could fall even further, making them hesitant to invest in oil companies or related industries. This simple math is the engine driving oil prices down, with ripple effects across the global economy. From energy companies to everyday consumers, everyone feels the impact of these price swings, reminding us just how interconnected our world really is. Where's all this extra oil coming from? Look to OPEC+, a group of major oil producers, including Russia. In 2025, OPEC Plus has steadily raised production quotas, adding to the glut. Why? These countries depend on oil revenue, and selling more barrels can offset lower prices. They're also protecting market share, wary of losing ground to U.S. shale producers. Every OPEC Plus decision sends shockwaves through the market, and their choice to keep pumping has kept prices under pressure. Their strategy is about long-term goals, but for the world, it means persistent oversupply and low prices. The result: WTI stuck below $60 with no rally in sight. Oil isn't just about supply, it's about currency too. While most people focus on how much oil is being pumped or how much is left in reserves, there's another powerful force at play: the value of the currency in which oil is traded. This often overlooked factor can have a dramatic impact on oil prices, affecting everything from the cost at the pump to the profits of oil exporting nations. Globally, oil is priced in US dollars, so when the dollar strengthens, oil becomes more expensive for buyers using other currencies. This means that even if the actual price of oil in dollars stays the same, the cost for someone paying in euros, yen, or rupees can rise sharply. The dollar acts as a gatekeeper, influencing who can afford to buy oil and how much they're willing to pay. If you're in South Korea or India, a stronger dollar means you pay more for the same barrel, even if the dollar price doesn't change. For these countries, oil becomes a bigger burden on their economies, leading to higher fuel prices for consumers and increased costs for businesses that rely on energy. This can ripple through the economy, affecting everything from transportation to food prices. This discourages international buyers, reducing demand. When oil becomes too expensive, some countries may cut back on imports, look for alternative energy sources, or even slow down economic activity to cope with higher costs. The result? Fewer ships leaving ports, quieter gas stations, and a noticeable dip in global oil consumption. Recently, the dollar has strengthened, making oil pricier for major consumers like China and India. These nations, which are among the world's largest importers of oil, now face steeper bills for the same amount of crude. This shift can have a huge impact on their economies, forcing them to make tough choices about spending and energy use. As their demand cools, oil prices face even more downward pressure. When big buyers pull back, the global oil market feels it. Prices can drop quickly, affecting not just oil companies, but also the economies of countries that depend on oil exports for revenue. So, when you hear about the dollar rising, remember, it's not just currency news, it's a key reason oil is dipping. The headlines about currency shifts are directly tied to what you pay at the pump and the health of economies around the world. The dollar's strength, driven by economic developments in Washington, is helping push prices lower. Decisions made by policymakers, interest rate changes, and economic reports all feed into the value of the dollar, which in turn shapes the global oil market. It's a reminder of how tightly connected global markets really are. Oil, currency, and economies move together in a complex dance, showing us that a change in one corner of the world can send ripples across the globe. Political drama in Washington can shake oil markets too. The recent U.S. government shutdown disrupted economic activity, especially air travel. The U.S. is the world's biggest fuel consumer. Fewer flights mean less demand for jet fuel and oil. As the shutdown neared resolution, the dollar strengthened, making oil more expensive abroad and pushing prices down. Ironically, good news from Washington can hurt oil prices by boosting the dollar. Political stability or dysfunction in the U.S. sends ripples through global markets. Traders watch Capitol Hill as closely as OPEC, knowing political decisions can shift demand overnight. The Senate's move to end the shutdown reassured markets, but also helped push crude lower. To understand oil prices, you have to look beyond oil fields, to the halls of power. Not all forces are pushing oil down, some are trying to push it up. The ongoing Russia-Ukraine war is a prime example, adding a risk premium to oil prices. Recent Ukrainian drone attacks on Russian energy facilities threaten supply, making traders nervous about sudden disruptions. Even temporary outages can tighten the market and send prices higher. The war keeps volatility high, as sanctions and attacks add uncertainty to global supply. Diplomatic failures mean this risk isn't going away. So even with oversupply, the threat of conflict keeps a floor under prices. The market is a tug-of-war between bearish oversupply and bullish geopolitical risk. That's why oil remains so volatile and unpredictable. In the Russia-Ukraine conflict, every attack sparks a response. After Ukrainian strikes on Russian energy sites, Moscow retaliates, escalating tensions. This cycle of attack and counterattack raises fears of wider disruptions to energy flows. Traders worry Russia could weaponize its oil exports, or that damaged facilities could cause regional shortages. Even temporary outages create uncertainty, keeping prices from falling too far. The conflict is now an economic war, fought with drones and missiles targeting energy lifelines. That's why traders keep a close eye on every headline from the region. The oil market is caught between powerful, opposing forces. On one side, oversupply, weak demand, and a strong dollar push prices down. On the other, geopolitical risks, especially the Ukraine war, keep prices from collapsing. This creates a fragile balance. Prices swing on every new headline, from OPEC decisions to military strikes. Right now, bearish factors are winning, but that could change in an instant. Oil prices reflect the net result of this ongoing battle between economic fundamentals and global instability. Understanding this balance is key to understanding today's prices. In oil, the only certainty is more uncertainty. So, what does all this mean for you? Oil prices affect your daily life. Lower crude prices usually mean cheaper gas, though it takes time to reach the pump. But it goes further. Energy costs impact everything from groceries to shipping. Lower oil prices can ease inflation, reduce heating bills, and slow price increases at stores. Even your electricity bill can be affected, especially if oil is used for power generation. The price of oil is woven into your household budget, from food to fuel. So, a dip below $60 a barrel isn't just financial news, it's real relief for your wallet. That's why we'll keep tracking every development for you.